Have you ever, looked at a price tag maybe or watched a small local business trying to make a go of it and just wondered what actually makes one succeed while another one struggles?
Hmm.
It's such a basic question, isn't it? But it applies to everything from the little shop on the corner to, well, huge global
Well, it really
companies.
does. It underpins so much.
So today we're doing a deep dive right into the heart of it all, the measure and importance of profit.
Yeah, the fundamentals.
Our mission really is to unpack these core ideas, revenue, costs, and then ultimately profit. What does it all mean? We're using the sources you sent over some textbook bits, specific examples, financial tables, a good
It's a
mix.
really useful set of materials, yeah.
And the aim is to pull out those key bits of knowledge. It's not just about definitions, is it? It's about the insights into how businesses, well, work, how they thrive.
Exactly.
Okay, let's unpack this then. Because profit, it's way more than just a number on a spreadsheet, right? It feels like the lifeblood of it all.
It absolutely is. And what's so interesting, I think, is how these concepts, which seem quite simple on the surface,
Hmm.
they really form the foundation for pretty much all economic activity.
Hmm.
Whether it's that local shop or a giant multinational, these principles are driving decisions every single day.
Hmm.
So we'll try and connect those dots, make sense of the business world that's all around us.
Okay, good. Let's start at the beginning then. Building blocks, getting money in, we all get price, right? That amount you pay for one thing.
Sure.
Simple enough.
But for the business itself, setting that price, it's not just picking a number, is it? You called it a tightrope walk earlier, and that feels right.
It really is, because that price, multiplied by how many you sell, the quantity that gives you your total revenue.
Right, TR, or turnover sometimes, sales revenue.
Exactly. Different names, same idea. It's
Yeah.
the total income from whatever the business does before you take out any costs. That top line figure everyone watches.
And the maths itself is like super simple. Total revenue, price X quantity.
Yep. P times Q. So the example given, £5 price, sell 10 units, that's £50 total revenue. Easy.
Right.
But the challenge is finding that sweet spot, that ideal selling price. It's got to cover your costs, obviously, and leave something extra, the profit,
Hmm.
but not be so high that people just say, no thanks. It's a constant balancing act with what the market will bear.
That's the absolute core of it. And where it gets interesting and a bit more complex is when you start thinking about how changes in one affect the other, price and quantity.
Yeah.
How does that ripple through to your total revenue? The sources give a really clear example here.
Yeah.
If your price stays the same and you sell twice as much, well, obviously, your revenue doubles.
Makes sense.
But, and this is the key bit, if you drop your price, say by 10%, you actually need to sell more than 11.1% more units just to keep your total revenue the same.
Wow, okay. So it's not a simple trade-off at all.
Not at all. It shows you need a bigger jump in volume to compensate for even a small price cut.
That specific number, the 11.1%, really makes you think, doesn't it? Businesses must be constantly doing that kind of calculation.
They have to be. And the sources mention this as maybe an oversimplification because it doesn't factor in something called price elasticity of demand.
Ah, right. Economics flashbacks.
Exactly. It basically asks, how sensitive are your customers to price changes? For some things, like maybe basic bread, people will probably buy it, even if the price goes up a bit. Demand is inelastic.
Mm-hmm.
But for, say, a fancy gadget, a small price drop might suddenly make loads more people buy it. That's elastic demand.
Okay.
Understanding that sensitivity, well, it's absolutely critical for figuring out your revenue and making smart choices about price. It really asks, how much power do you actually have over your pricing?
And if you think about your own shopping, you probably get this instinctively, right? How often does a sale make you buy something you wouldn't have otherwise? Or choose one brand over another?
Yeah, exactly. These aren't just abstract ideas. They affect our choices every day.
Okay, so that's getting money in, revenue. But that's only half the story, isn't it?
Not even half, some might say.
Because behind every product, every service, there are costs. Loads of them. These kind of invisible engines running in the background.
Invisible but crucial.
And the sources really stress that managing costs well isn't just, good housekeeping. It directly boosts your profit. Things like reducing waste on a production line or improving quality so there are fewer returns. That's all cost management.
Precisely. And the fundamental way businesses think about costs, the key distinction they have to make is between fixed and variable costs.
This is super important.
It really is. Getting this right can be the difference between making it and breaking it.
So fixed costs, these are the ones that basically stay the same in the short term, no matter how much stuff you're producing.
Right. That's the idea. They don't vary directly with output.
And the examples are things like the rent on your factory or office, machinery, salaries for admin staff, maybe, marketing budgets, even the basic heating and lighting bill.
Yeah, all those things that you kind of have to pay whether you make one item or 10,000, they're the baseline operational costs,
Okay. And then the other type.
variable costs.
Mm.
And these do change directly with your output level.
So more production means more cost.
Exactly. Think raw materials you need more if you make more products. Wages for the workers actually making the stuff, often called direct labor, the power used by the machines during production.
Got it. So make more, these costs go up, make less, they go down.
Simple as that. And then your total costs. Well, that's just adding the two together.
Fixed costs plus variable costs equals total costs. Okay.
And the sources highlight how output changes affect these differently. That's a really important rule.
Mhm.
If your output doubles, your total variable costs will also double. Makes sense, right?
Yeah, you need twice the materials, maybe twice the labor hours.
Exactly. But your fixed costs, they just stay the same.
Still paying the same rent.
Right. And the reverse is true, too. If output drops 10%, your variable costs drop 10%. But fixed costs, still the same. Understand this is so important for planning.
Okay, let's make this concrete. The magazine producer example from the sources is good here.
That helps illustrate it.
So imagine their fixed costs are 5,000 pounds per period. And the variable cost, maybe printing and paper per magazine, is 6 pounds.
Okay.
If they print 1,000 magazines, the total cost is the 5,000 pounds fixed, plus 1,000 times 6 pounds, which is 6,000 pounds variable, so 11,000 pounds total.
Right.
But what if they only produce, say, 60 magazines? The fixed cost is still 5,000 pounds, but the variable cost is only 60 times 6 pounds, which is 360 pounds.
Big difference.
Yeah, so the total cost is only 5,360 pounds. It really shows how that variable element scales while the fixed part is just there.
It does. And for anyone listening, maybe running a business is where things get practical, a common mistake is maybe misjudging what's fixed and what's variable.
Ah, okay. Like how?
Well, you might think salaries are fixed, but if you pay overtime when production ramps up, that overtime portion is actually variable, isn't it?
Good point, yeah.
Getting those classifications right is vital for knowing the real impact of changing how much you produce. And it links to forecasting costs, too.
Right. The sources mention forecasting is crucial because costs can jump around and affect future plans.
Hugely. They mentioned 2012 when raw material prices like oil, tobacco, paper went up by different amounts. There's even that graph showing UK petrol prices bouncing all over the place between 2006 and 2014.
Yeah, I remember seeing that. Wild swings.
Businesses need to try and anticipate that stuff to protect their the bottom line.
Which brings us perfectly to the bottom line. Profit.
The big one.
The sources define it simply as the difference between the income of a business and its total costs. Everything that came in minus everything that went out.
Yep. Profit, total revenue, total costs. That's the fundamental equation.
And the material points out there are basically only two ways to make that profit number bigger, right?
Fundamentally, yes. You either increase sales revenue,
Sell more stuff or sell it for a higher price.
or you decrease costs, find efficiencies, cut waste, negotiate better deals.
Every business strategy seems to boil down to one or both of those in the end.
Pretty much. It's about widening that gap between income and outgoings.
Let's go back to the magazine producer again. Table 1.3 in the sources is really helpful here. They assume a selling price of 2 pounds per magazine.
Okay.
At zero output, we already know costs are 50,000 pounds fixed. With zero revenue, that's a 50,000 pound loss straight away.
Ouch. Starting in the hole.
Then, if they sell 40,000 magazines, they're still making a loss. 10,000 pound loss, according to the table.
Still not covering all those costs.
But here's the crucial point. If they manage to produce and sell 60,000 magazines, bang, they make a 10,000 pounds profit.
Right. They cross the line. That's past the breaking point.
Exactly. From losing money to making it. And if they push output way up to 120,000 magazines, the profit jumps to 70,000 pounds.
Shows how scale can dramatically change the picture once you've covered those fixed costs.
It's amazing how clearly those numbers show that tipping point.
It is a powerful illustration. But it also makes you ask, okay, so profit means you're not losing money. But why is it so important beyond just staying afloat?
Good question. It's not just about survival.
Not at all. The sources list several key reasons. First, it's a reward.
A reward for?
For the owners, for taking the risk in the first place, for putting in the hard work and the capital. It's their return on investment.
Okay, that makes sense. It's fair compensation for the risk. And it's also a motivator, isn't it? Not just for owners.
Absolutely. The sources mention the John Lowe's partnership and their profit-sharing schemes. When staff know they'll get a slice of the profits, it aligns everyone towards that common goal. It motivates managers, employees, everyone.
Yeah, gives everyone a stake in success. What else?
Profit is also a vital measure of success. It's a benchmark. How are we doing compared to last year? How do we stack up against our competitors? Healthy profits usually signal a business is doing something right,
Mm-hmm. A key performance indicator.
and it also guides future investment. Where should the business put its resources next? High profit areas often attract more investment to maximize returns. It helps steer the ship.
Okay. And maybe most importantly,
Okay.
it's a source of finance, right?
Hugely important. This is about retained profits, the profits the company keeps, instead of paying out to owners or shareholders, often called plowed back profits,
And they use that money for.
for growth. Buying new equipment, expanding operations, research and development, basically investing in things that will hopefully generate even more profit in the future. Means they don't have to borrow as much.
Right, internal funding, less reliance on banks or outside investors.
Exactly. And finally, being profitable makes a business attractive to stakeholders.
Stakeholders meaning.
Anyone with an interest. Suppliers feel more secure dealing with you. Customers trust you'll be around. It's easier to attract good employees. Profit signals stability and reliability to the outside world.
Okay, that's a really comprehensive view of why profit matters so much. It touches everything.
It really does permeate the entire business.
Let's look at that source of finance aspect a bit more. Profit in action, making strategic decisions. This idea of retained profits seems key for growth.
It is. As we said, it's the profit kept back, not paid out as dividends, specifically to reinvest in the business, buy assets, and hopefully boost future profitability.
But that must create some tension sometimes, right? Between keeping the money for the future versus giving it to shareholders now.
Absolutely. And the Rolls-Royce example in the fact file section of the sources illustrates this perfectly.
Yeah. Tell us about that.
Well, in 2003, Rolls-Royce actually made a loss, £53 million. So, understandably, they paid no dividend to shareholders that year.
Makes sense. No profit, no payout.
But then, things improved. From 2006 to 2009, they were profitable and did pay dividends.
Okay.
But then, they hit difficulties again between 2010 and 2012 and had to suspend dividends once more.
So it's not automatic. Profit doesn't always equal dividends.
Not necessarily, and the source makes a really interesting point here. It says, companies are often accused of taking short-term decisions to satisfy the immediate needs of shareholders, but Rolls-Royce has shown that it can plan long-term.
Okay, let's unpack that. So Rolls-Royce chose not to pay dividends sometimes, even maybe when they could have scraped some together, because they were prioritizing long-term investment.
That seems to be the implication. They were potentially retaining earnings to strengthen the company for the future, even if it meant shareholders didn't get an immediate payout. It highlights that classic tension.
That story really does bring it to life. These aren't just numbers. They're major strategic calls affecting huge companies and, their future path. It really is a balancing act. It's incredibly delicate. How do you balance rewarding the people who own the company right now with investing that profit back into the business to make sure it's still strong, still growing 5, 10, 20 years down the line?
Yeah.
That decision about what to do with profits, it's fundamental to corporate strategy. It really makes you think, how do businesses juggle that short-term pressure, often from the stock market, with the need for a sustainable long-term vision?
It's a really tough call. And it makes you, as maybe a customer or potential employee, think differently about a company, doesn't it? How they handle their profits tells you something about their priorities, their confidence in the future.
Mm-hmm. Their stability, their strategy, it's revealing.
So, quite a journey we've taken there. We started with the basics price, getting revenue in the door,
Mm-hmm.
then the costs, breaking them down into fixed and variable, seeing how they behave,
Then putting it together to calculate profit, total revenue minus total costs.
and finally,
Yeah.
exploring why that profit figure is so incredibly important. As a reward, a motivator, a measure, a guide, and a source of finance.
Yeah, it's far more than just accounting. Understanding these building blocks really is crucial if you want to grasp why businesses make the decisions they do.
Absolutely. It helps decode the economic forces shaping, well, everything around us. How the products we buy get made, why some companies succeed, It all comes back to these fundamentals.
It gives you a much deeper perspective than just looking at a price tag or a news headline.
Definitely.
Which leaves us with a final thought for you, our listeners, to chew on. Given how absolutely central profit is for a business's survival, its growth, its ability to invest and innovate, how might things change if we all, as consumers, as citizens, had a maybe deeper, more nuanced understanding of the profit motives and the financial workings of the companies that play such a big role in our world?
That's a great question to ponder. What difference would that deeper understanding make?
Something to think about. We'll leave it